Okay, good morning, everyone. Welcome to the class today, 25th of October, 2020.
Good morning, sir.
Okay, good morning, everyone. Good morning. Okay, today, as we have agreed yesterday, we are going to more or less be looking at group adjustments. Okay, and we are going to explain what leads to group adjustments. We are going to identify transactions that could give rise to group adjustments. And we are going to demystify how group adjustment is carried out for each level of transactions that occur within the group, which we call intra-group transactions, or in some quarter, they call it intercompany transactions. These are all what we are going to consider today. And by the end of the two-period class we are going to more or less carry it out today, there will be a task for you guys to go ahead to pick question 3 of the November 2019 diet, where a simple group account is required of you with understanding of the principles that we have more or less covered over time. And that's what I'm displaying on the screen. Okay, and by this time next week, you'll be so glad with yourself that, is this all required for me to know? Is it so simple compared to what I expected? And you find it that there's nothing really hard and there's nothing really simple. It's a function of your understanding. If you have understanding, it looks simple. Where you lack the understanding, it looks difficult. And that is just it. And you are going to find out how people can more or less demystify these questions and find out that what will always give you a leeway is the understanding of the principle and the application of those principles to solving a real life problem. And that's what we are going to consider today. And let's go back to our material. Let me try and share the screen based on our material. Okay, this was where we stopped yesterday, and we are to start from adjustment to group account. If you recall from all of our discussions, you find out that at the inception, where we tried to explain what group accounts is all about, the conclusion we reached and we all agreed to then was that group accounts are the accounts of the parent and of the subsidiary, as if is an account of a single entity. And what that presupposes is that group account is not just a mere addition of the account of the parent and the subsidiary. Rather, it is the addition of the parent's account and the subsidiary on the premise that certain adjustments are made to fuse the two companies together as one. Remember, the word as if it is the account of a single entity is a simile. Simile in the sense that it's like, not necessarily it is. The same way I explain to people about marriage. The coming together of husband and wife should be seen as one. Does not necessarily make them one. but they should be seen as one. And why they are not one is that the husband cannot go on to write ICANN exam for the wife. But if they are truly one, and one in its real sense, that means the husband can write the exam for the wife. Likewise, the wife can assist the husband at workplace to do the work. But again, you must still remember that as if they are one is to say that anything done by both of them is seen to be accruable to the family. Okay. Likewise, group. In a group, you must still understand that from the legal structure, the parent is a separate legal entity. Likewise, the subsidiary is a separate legal entity. It is from the economic substance and from the financial reality perspective that made financial reporting requirement to consolidate them as a group, which means to be seen as one. Okay, now in doing so, you understand that one of the critical reasons why there's an acquisition or there's a business combination is the synergy that tends to draw value to the combination. And the synergy cannot be arrived at efficiently if the two parties do not have something in common or do not exchange activities in order to maximize benefits, which means it is the result of this desire to achieve that synergy by interacting, engaging in common transaction, and synchronizing activity that give rise to what we call intra-group transactions or intercompany transactions. Now, in summary, intra-group transactions are transactions that emanate between the parent and the subsidiary. Now, let me break it down into practical substance. It is possible for the purpose of economic of scale, and given that the parent and the subsidiary somehow operate in the same industry, and probably the only thing that separates them is that they operate in different territories. Let us say the parent operates in the south of the country and the subsidiary operates in the north of the country. And it's because of expansion towards the north, that is why the parent acquired the subsidiary that have a dominance in the north. Now they become a member of the same group. Now, since they deal with the same product, only that they operate in different geographical locations, what then happens at that point in time is that to achieve the synergy is for them to tap into what we call economies of scale. What is economic of scale? Rather than the parent independently procure its own products, and likewise the subsidiary independently procures its own products, why can't they have a common force to procuring their product jointly, and such responsibility bestowed probably in the hands of the parent? What do you believe you could achieve as a result of that? One thing that is common you achieve as a result of that is that you will have more or less a bargaining power as a buyer with your vendors. Why? Because you now have a mammoth, or what we call the huge quantity desired or demanded. And you can use that as a basis of negotiating good terms and favorable terms, which include one, good pricing by annexing relevant discounts. Two, you can use it to annex payment terms where you have an extended credit period. And three, you can use it to gain what we call the loyalty of the supplier to you and all other things in that manner. What that means that such is the reason why there is an acquisition to drop synergy based on relationship within the group. Similarly, what can also be of benefit of working in that context or in sync within the group is that let's assume the parent is a cash cow. It's usually having a surplus cash position. And before the acquisition, the parent will have approached a bank, let's say GT Bank, and fix the money for 10%. And again, the subsidiary is less cash cow, who is always in the position of going to bank to borrow. And if you have gotten to the bank, it will have borrowed at 15% or 18%. Now, since the parent has now acquired the subsidiary, what sense exists therefore to say the parent will still continue to put his money in GTB fixed deposit at 10% and will now require its subsidiary to go and borrow in the same GTB at 15 or 18%? Doesn't make sense. Therefore, what happened? Because they are now a member of a group, they can more or less cross the cash, what we call cash sweeping or cash pooling within the group, whereby the parent can now loan the money to the subsidiary, even at higher rate than what GTB is giving, which is also favorable to the subsidiary borrowing lesser than what GTB will have given. Let's say they agree at 12%. It pays both parties. It pays the subsidiary to have more or less borrowed less than what the market is. And it pays the parent also to have given loan and any interest above what the market is giving. This is how you draw synergy within the group. Another way you could draw synergy is that as the parent tends to expand, its capacity is increasing. Therefore, the parent probably have to relocate its factory or its head office to a bigger location. What stops the parent transferring the assets of the former location to the subsidiary rather than selling it outrightly to a third party? And in that situation, what happens? You have transfer of assets within the group. And that also creates a lot of synergy. These are examples of intercompany transactions that may be considered within the group for relevant adjustments. Another one you need to also understand is that every investor invests in a company for a return. And apart from capital appreciation, apart from involving in the affairs of the investee towards your advantage, one thing is sacrosanct, is that everybody expected a return in form of dividend from the subsidiary. Therefore, at every point in time, the subsidiary declares a dividend or pays a dividend. It then creates what we call an intercompany transaction, because significant amount of that dividend is payable or paid to the parent, which means every exchange that occurs post-acquisition between the parent and the subsidiary is what we conclude and term as intra-group transactions or intercompany transactions. Now, these transactions thereby may have created profit as a result of the transaction. But that profit then needs to be analyzed into whether that profit actually, from the group perspective now, not from the individual entity's perspective, but from the group perspective, is that profit realized? The word realized is that profit appropriately earned? If that profit is appropriately earned, It then means we have no cause for alarm. But if we realize that a portion or a whole of that profit is not earned or realized, therefore we have a cause for concern. And we're going to discuss that later. But how do I know that a profit is appropriately earned in a group, or profit is actually realized from the group perspective? It's for me to say, where does profit emanate from? Profit really should emanate from transaction of the group with external parties, or with what we call the third parties. Now, if the profit you are talking about is as a result of transaction that eventually has exited the company or the group to external party, therefore we say such profit has been realized. But if that profit is as a result of transactions that were carried out between the parent and the subsidiary, such that the final impact has not left the group by way of dealing with external or third parties, such profit will be considered unrealized because it is yet to be appropriately earned by the group, even though it might have been appropriately earned by a member of the group. But it is considered not to be appropriately earned within the group because that burden has not shifted from one member of the group to the third party. Let me give you an example. If the parent bought goods for 10 naira and sold it to the subsidiary for 12 naira, from the parent perspective only, the parent has appropriately earned 2 naira as profit. Now, if the subsidiary has eventually sold that same goods for 13 naira to third party, the subsidiary has also appropriately earned 1 naira, be it the excess of 13 naira over its own cost of 12 naira. Therefore, in that light, we will say 2 naira made by the parent, 1 naira made by the subsidiary, make up 3 naira made by the group. These 3 naira has been appropriately earned and it is realized. But can we say that if the parent bought at 10 naira, sold to the subsidiary at 12 naira, though the parent has appropriately made 2 naira and realized, but unfortunately, as at the reporting date, which is the end of the year, the subsidiary has not been able to sell the goods to third party, which means the goods constitute part of the stock in the hand of the subsidiary as at the reporting date, which means it constitutes part of the inventory or what we call the unsold goods. Now, the question then is, though the subsidiary has made its 0 profit because he has not sold any, though the parent has actually realized and appropriately earned 2 naira because he has sold as an independent and separate entity. But if you are to add it together, we'll say 2 plus 0 make up profit of the group of 2. But can we say this 2 is appropriately earned or realized from the group perspective? Our answer will be no. Why is it no? It's no because you can't make profit out of yourself. Profit must be made with your dealings with the external party. Remember, from the group perspective, the subsidiary is not an external party. It's like when you sell goods, you open shop, and the only person that bought from you is your wife to cook for the family. And you say you have made profit at the end of the day. Profit from where? From yourself. Such is not profit from the group perspective. It's just a notional profit, which from the consolidation perspective, such profit does not exist and we have to be eliminated. Which then means that as a result of group transactions, there might be need to identify profit that is realized away from profit that is not realized. The portion that is realized from the group perspective, we have no problem about it. And we have no cost for alarm. We have no cost for adjustment. But for those that are considered unrealized, we have the responsibility to adjust for them because such profit is not appropriately earned until the impact affect the third party. That is one. Another thing that will come up there is that if you have transaction with your related party, the same transaction, especially if it's at arm's length, will create similar term or credit term with third party, whereby when you sell, you don't expect to get money immediately. When I buy, you don't expect to pay, I don't expect to pay immediately, which means peradventure our dealings throughout the year might have created some outstanding payments that is due from one party to the other, which means at the end of the day, it is not possible that at the end of the year, the parent might have a receivable from the subsidiary, similar to receivable from third parties. Also, the subsidiary might have payable to the parent, similar to payables to other vendors, which means we now have a concern to say, part of my receivable as a parent include that of my subsidiary. Similarly, the subsidiary have a concern that part of my payable include payable to my parent. Now, from the group perspective, we say consolidation entails a line-by-line addition of the parent's line item of asset and liabilities with that of the subsidiary, subject to an adjustment. What is the adjustment? Is that I cannot consolidate receivable from my subsidiary within the group. Neither can I consolidate payable by my subsidiary within the group. Why? Because this is like I'm dealing with myself. I can't owe myself. I can't expect anything from myself, which means on one hand, I'm expecting something from myself. On the other hand, the same me, I'm expected to give something to myself, which means you just need to cancel it out because it doesn't create any economic value. Even though, take note, if you fail to cancel it out, you still have your balance sheet in agreement, but that does not reflect your true economic or financial position. Which then means that whenever you have intercompany balance, payable on one side, receivable on the other side, they must be eliminated. And that is on the premise that parent says I'm to receive 10 million, subsidiary says I'm to pay 10 million, which means they are in agreement. Therefore, we just eliminate. But not all times are they in agreement. And we're going to look at that. Because sometimes the parent might say, I'm to receive 10. The subsidiary says, no, I'm to pay 9. The next question you ask yourself is that if you find yourself in such a situation, even with the third party, two of you have to sit down and carry out what we call reconciliation. Reconciliation is to identify what had transpired between both parties from the beginning of the year to the end of the year. And you more or less cast out things that are common. After casting out all things that are common, what is left out is unreconciled items that need to be explained. And the explanation will give room to understanding what is appropriate and what kind of adjustment to be done. And in practice, three things usually cause these differences or unreconciled item. The first one is issue of error, which you can more or less consider as accounting error. Error of probably you transpose figure, you want to write 110, you write 101 in your postings, and therefore it created imbalance, or you have total omission of something, and also of things like that. But if it's error, in line with your understanding of correction of errors, you correct for it and you move on. But there are two other ones that are the main reason why such differences exist in practice. The first one is issue of cash in transit. Cash in transit means that peradventure, the parent's bank is GTB. The subsidiary's bank is Zenith. Now the subsidiary is owing GTB, owing the parent And the subsidiary has more or less given instruction, banking transfer instruction to the bank to pay his parent. Now, Zenith has more or less debited the subsidiary and has wired the money through NIPS, okay, which is the payment channel platform for interbanks. Now, unfortunately, due to one reason or the other, the money did not get to the account of the parent in GTB due to many reasons. But the money has left the account of the subsidiary. In subsidiary's mind, I have paid because I gave instruction and it has been acted upon. The money has left my account. But from the part of the parent, I have not received anything. Therefore, at that point in time, and unfortunately, this occurred between end of the year and the beginning of the next year, which then means that by the closure of the individual books of the parent and subsidiary, the subsidiary will have more or less accounted for a reduced obligation to the parent because he has paid. But the parent will still maintain the old balance because I have not received. But unfortunately, or fortunately, the money was not received 2 days after the year end. But remember, those companies are going to close their books based on the actual position, which then means that for the purpose of consolidation, you now find out that the parent is saying I have receivable of 30 million. The subsidiary is saying I have payable of 20 million, which means there's a difference of 10. And you can't go ahead to cancel 20 with 30, which means to create that imbalance. What then you need to do is that after reconciling, we identify that cash in transit, we adjust for it appropriately. Upon adjusting for it, you now find out that both the parent and subsidiary will have the same balance, and you proceed to cancellation. Similar to cash in transit is what we have as goods in transit, which means the same treatment, only that one is cash, one is item of goods. Okay, that is that. Another one we can have is that issue of sale of items. It could be sale of goods, it could be sale of asset like PPE. Now, if it's sale of goods, it does not give rise to depreciation adjustment. But if it's sale of assets, it usually gives rise to an adjustment for depreciation. Why? Because at the time you make sale, okay, you are deemed to have made a profit. But one thing you need to understand about it is that that profit is deemed not to be earned because any asset transfer within the group is expected from the economic substance not to create any value or reduce value, as the case may be. Which means that any profit element added to it based on the fact that you want to deal at arm's length will be considered unrealized and will be adjusted appropriately. But unfortunately, remember, from a single entity perspective, both entities have to operate separately and account separately. And in that light, what then happens is that the subsidiary or parent who got the asset from the other will still maintain depreciation based on the transaction that occurred, which then means that giving rise to either of excess depreciation charge, which you have to revert, or give rise to under depreciation, which you have to recognize an additional depreciation to make it up. And that also is a form of group adjustment that might come up. And these are practical discussions on group what? Adjustment. But again, group adjustment results from intercompany transactions or intergroup transactions. At this point, before we move into practical discussions, I want you to ask questions or make contributions, as the case may be. For those that want to ask questions, you can raise up your hand. And for those that probably their network might be failing, they might ask questions by just going to the chat box and put up the question. We have these few minutes to ask, contribute, and answer questions. Okay, Blessing. Okay, you can unmute yourself and ask your question now.
All right, sir. On your explanation on cash in transit, which you said it has to do with the payments made by the subsidiary to the parents, but at that time the parents has not received it. So I didn't get the treatment.
No, we are not talking about treatment yet. I'm just giving you practical things that could lead to intra-group adjustments. We are going to pick them one by one, treating them one by one. Is that okay?
All right, sir. Thank you, sir.
Daniel.
Yes, sir. I just want you to clarify the issue of unrealized profits on the issue of transfer of goods between the parent and the subsidiary. I still don't understand how the rationale behind it works.
Yeah, we are going to look at it. You know, what we gave is a background information about all of these adjustments, okay? But the next phase is to go into those adjustments one by one. Is that okay?
Thank you, sir.
Any other question? Any other question? Okay, there's no question. Okay, we'll move on. Now, let's go back to the slide. All what I've explained to you, you could find them here about various intercompany transactions that give rise to intercompany adjustments. But my first point of call now is discussion on unrealized profit on inventory. Okay, now, unrealized profit on inventory, what does it depict? What we are trying to say is that at every time there's a transaction between the parent and the subsidiary which involves sale of goods, any profit made by the parent have to be analyzed into the portion that is realized and the portion that is unrealized. I repeat, when there's a transaction between the parent and the subsidiary that involves sale of goods, these have to be analyzed into the portion that is realized and the portion that is unrealized. Now, how do we know? We ask ourselves a simple question. At this point, we'll be using terminologies, which means when you hear intra-group sale of goods, you know that it's sale of goods between the parent and subsidiary, so that you don't think of selling to customers. No. In this case, it's within the group. Now, look at it. The parent bought goods for 10 naira. And the parent sold it to subsidiary for 12 naira. Now, you will have said the profit on sales is how much? 12 naira minus what? 10 naira. That gives how much? 2 naira. Our concern is to say this 2 naira we have to more or less analyze it into realized and what? Unrealized. Now, the word realized means that the subsidiary that bought these goods for 12 naira, are you sure that the subsidiary has sold them or they remain what? Unsold? Now, if the subsidiary has sold them, probably the subsidiary sold them for 13 naira. You know, the subsidiary will have made 1 naira profit. Now, in this case, we will say this 2 naira is entirely realized. But let us say the subsidiary has not sold them. It means the subsidiary will have made 0 revenue. Therefore, we say in this case, it is what? This 2 is unrealized. Why is it unrealized? Because the profit made by the parent was made from the sweat of the subsidiary, which then means that you as a parent, forgetting that the subsidiary is part of you, is your flesh. Therefore, can you say you have made anything? Can you rejoice on it? Imagine your wife opened shop and she came back and said, I've made 2 naira. And you ask her, but I came to the shop to buy something for 12 naira. And that thing, you bought it for 10 naira. That means the 2 naira you made is only from you. And I say, yes. I will now ask you, why are you dancing? You understand? This is still from the family money. You have not made anything because you have not added any new thing to the family. It's still money within the family that we are redistributing, which has not created any value. But if you told me that the 12 naira you sold, no member of the family purchased it, or the member of the family that purchased it from you have equally been able to sell it to other party and has made money. Therefore, I can now conclude that this 2 naira is actually a profit made from our dealings with external parties. Which then means that at every point in time, your profit on sales should be analyzed. And the base of analysis is that what portion of it has been sold by the other member of the group that bought it from the other to third party. And what portion of it remain what? Unsold. Which then means that if 100% of it has been sold, it then means that 100% of this 2 naira is realized. If 0% of it is sold, which means the entire 100% is unsold, it means 100% is unrealized. But if it's a mix means that all what you sold to your subsidiary, part of it your subsidiary has sold into others, while part of it remains in inventory. In that situation, you now have to look at it. What proportion was sold by my subsidiary to third party? Let's say it's 60%. In that case, you say 60% of 2 naira is realized. Which then means that the portion that is unsold is what? 40%, which means 40% of 2 is unrealized. And what is our concern? Our concern is only with respect to unrealized, because the realized is already embedded in the profit of the group. That is the realized, plus that unrealized. But we are not saying that the entire 2 naira constitutes realized and unrealized, but the entire 2 naira has been incorporated in the group profit. What then do we need to do? Let us go and look for the portion of that 2 which is incorporated in the group profit that is not realized, and let us eliminate it, so that the group will not be dancing, rejoicing, and spending on profit that has not yet been appropriately made. And remember our concept of prudence, or our concept of what? Conservatism. Therefore, you can't anticipate profit that has not been appropriately earned. And that's what we are trying to say here in this case. Now, another thing that we need to understand before we go into practical sessions is to say, remember that profit in accounting can be determined either by way of markup or by way of margin. Remember, profit can be expressed relatively by way of markup. When you say markup, what you are simply doing is that you are expressing profit as a percentage of cost. And when you say margin, you are expressing profits as a percentage of sales or selling price. Remember, that is why by expression, you will say markup is profit over cost, which is same thing as P over C. Why margin, by our expression, is always considered as profit over.
Excuse me, sir, you're not sharing your board.
Hey, sorry. And you didn't tell me on time. Okay, let me share it. Now, this was the first one I mentioned, which was the same thing as the example I made earlier. Okay, but this is what I'm doing now. Margin is our selling price. Profit as a ratio of selling price. Remember, which is P over what? SP. Okay, now recall that your selling price, which is SP, is always determined with reference to your cost plus the profit you want to make on that cost. Okay, these are things that are basic that we all understand. Now, let me quickly take you back to this expression I was making the other time that I think I didn't share. I said the first thing is that intra-group transactions, and in this first leg, we are looking at intra-group sale of goods. I said if the parent bought goods for 10 naira and the same parent sold that item to the subsidiary for 12 naira, okay, the parent is said to have made a profit on sales of 2 naira. Our concern of this 2 naira is to say, is it realized or is it unrealized? And I said, whether it's realized or unrealized is a function of the fact that the subsidiary has been able to sell all of the goods or not. If you have sold all of the goods, we say the entire 2 naira is realized. If you have not sold any of the goods, we say the entire 2 naira is what? Unrealized. But we said, peradventure, he has sold 60% of the goods, which means 40% remain unsold. We can now say, what fraction of this 2 naira is realized? Is 60% of 2 naira. What fraction of this 2 naira is unrealized? Is 40% of this 2 naira. And that's what I've expressed earlier. Thank you for that observation. Okay. Okay. Let me take this up. I did that on page.
Hello, sir. Can I ask a question, sir?
Okay, what's your question?
Okay, concerning the unrealized profit, you said the parents sold to the subsidiary and the profits realized is 2 naira. But in the case where the subsidiary eventually sells the good outside and the profit realized is different from, it's not the same as what the company, the parent realized, is there like an adjustment for it, or is there going to be a separate issue?
Okay, those are the things we are saying. There will be an adjustment, but you must understand what will bring about the adjustment so that you can know how to determine the adjustment and how appropriately you will pass that adjustment. Is that okay, sir?
All right, sir.
Do you get what I'm
Okay,
saying?
if you have examples, is there an example you can use to illustrate?
Example, what do you say?
Do you have like an example you can use to illustrate, like for the adjustment, for an adjustment?
And that's what we wanted to do. That's why we are discussing the principle first. Do you get what I'm saying now? Because if you don't understand the principle, you won't know when to adjust and when not to adjust. That's what we are saying. Is that okay?
All right, sir.
Yeah. Now, we've discussed the principle. We can now move on to our question. Now, let me take you back to the question. We are going to look at this question to demystify our understanding. And I believe you all have a question. Now we'll look at this question 13. I'm going to read it and analyze it before we pass relevant adjustments. The question reads as thus. Pali PLC acquired 160 million shares of Suzy PLC when the reserve were 20 million naira. Pali PLC transfer plan to Suzy PLC for 40 million naira. And that plant has a carrying amount of 36 million naira as at the date it was transferred, which was 1st of January 2014. The group has a uniform depreciation method for the same class of asset, which they said is straight line method. The remaining useful life of the plant was said to be 10 years. During the year to 31st December 2015, which means from the beginning of the year, 1st of January 2015 to 31st December 2015, Pali sold goods that cost it 10 million naira at a profit of 20% on the cost to Suzy. Now, information reaching us as at the reporting date says that only 40% of these goods were sold to external customers by Suzy. Now, in the same period, the company has presented their financial statements, which shows our balance sheet position as given below. Now, what they now ask us to do is that we should prepare the consolidated statement of financial position as at the end of the year 2015, giving this information relating to intercompany transactions. Now, the first thing I want to ask you guys is, and I'm going to open the floor for anybody to unmute and answer. Can you identify how many intercompany transactions do we have and list them?
Can I answer?
Okay, you can.
Hello, good morning. Okay, we have 2 intercompany transactions.
We have 2 intercompany transactions. Okay,
Yes.
wait. Question 13, page 33.
Page 33.
Now, intercompany transactions.
Yes.
You said we have 2. Can you list them? 1.
Okay, we have a transfer of PPE to.
I can't
We
hear
have
you.
a transfer of. We have a transfer of
PPE.
on plant, on Mazat.
Okay. Yeah, there's
And
a
also
sale or transfer
of plants to Susie.
of plants. Okay.
No, sorry, I think that should be the transfer of the plant was at the beginning. So I think is a consideration as at the acquisition date.
No, no, I didn't get it. What are you saying?
Sorry. Oh, sorry. Okay. I'm a bit confused though. The transfer of plant and the sale of inventory, there are two different
Wait,
there are
wait.
two different topics.
Let us go back.
Okay.
Don't miss anything.
So,
How many
okay.
intercompany transactions are there and
Okay, I'll
listed?
say one.
Okay, you are now saying one.
Yes.
Okay. Which one is it?
That is the sale of goods to Susie at 10
Sale
million
of
goods. That is
sale of
costing
what?
10 million.
Goods.
Sale of
Okay.
goods. Yes.
Okay, no problem. Thank you. Who else want to attend to us? Who want to assist us? Who want to assist us?
There are two transactions, sir.
Okay, what is the first one?
The first one at the beginning says that there was a transfer of plant to Susie. And the second one is the sale of goods to Susie.
Okay, which means there is sale or transfer of plants. Okay.
Yes, sir.
Thank you. Now, you can mute yourself. Okay. Now, the answers, the correct answer is two intercompany transactions. Okay. The first intercompany transaction is that sometime in 2014, the parent transferred one of his plants to subsidiary. Okay. The lady, Ekemeze, or what's her name, initially got it right, but got confused to mix it up with consideration at the point of acquisition. And I believe that even today, when I listen to when Israel was explaining, Israel told you that that consideration was to the original shareholders of the parent. That is at the point of acquisition. It's quite different from transaction between the parent and the subsidiary. In this case, the asset transfer is to the subsidiary. It's like selling to the subsidiary, which constitutes part of what I explained today, which is an intercompany transaction. Any dealing post-acquisition between the parent and the subsidiary constitutes an intra-group or an intercompany transaction. Take it for that. Okay, the second one, which is clear, there's no issue about it, is that there's a sale of goods. Now, these two transactions, having identified them, the next thing for us is to determine what appropriate adjustments should we carry out. What appropriate adjustments should we carry out? Now, let's carry out the appropriate adjustment. Let me go back to my slide. Now, we have identified, let's now do the adjustment one by one. First adjustment is on what? Intra-group sale of what? Goods. Now, the first level is that what is the profit made on these sales by the parents? What is the profit made on these sales by the parents? Who can tell me what was the profit made by these sales from the parents?
So can I go ahead? They made.
No, hold on. Olamide want to ask questions. Olamide?
Hello, sir. Can you hear me now?
Yes, we can.
Yeah, Mr. Israel, I'm a bit confused because the last time Mr. Israel said something about when we were dealing on purchase consideration, he said transfer of acquiring assets. So in this case, when we have transfer of plant, see that we can't group that as a part of purchase consideration.
Transfer
Or
of
it is
acquiring asset to who? To who?
okay to the subsidiary.
What he told you, is it to subsidiary or to the owners of the subsidiary?
Okay, to the
Before the
owner of the subsidiary.
This one, what is it to?
Okay, transfer of is to the subsidiary.
Are they the same?
Okay, no, sir.
That's why, I've continued to emphasize, and luckily, I listened to when Israel was explaining. He even distinguished and broke it. As professionals, we start to learn to focus much more on understanding the principle and the salient, not just to take, because some of us are just taking any asset transfer is consideration, without taking into consideration, who are you transferring to? For what purpose are you transferring? At what point? These are the questions that need to be asked. Do you get what I'm saying now? You don't solve any problem based on hindsight or based on what you believe. No, you base it on the facts and circumstances before you. Is that okay?
Okay, sir. Thank you.
Yeah, thank you. Now, somebody also said something here. He said, we're not told date of acquisition. I've told you guys, even I mentioned it yesterday. Okay, if you are given the date of acquisition to be 2010, of what significance does it have in this question? Salami, can you answer that? Because you asked that question.
Good morning, sir.
Yes, good morning.
Yeah, sir, to be fair enough, I feel if we were actually, I don't know, maybe it's not in all cases that we are explicitly told the date of acquisition. But I feel if we had been told the date of acquisition, we would have said, okay, this was a transfer to subsidiary and not the previous owners of the company.
That is where you are making a mistake. The first thing is that even if you are giving the date, does that change the fact that they've given you information that this was transferred to the subsidiary?
They said to Susie. It's not like Susie.
Susie is who?
Sir, Susie could have been the former owners. The name of the company is
now, madam, at this level, you are saying Susie could have been the former owner. Can you say Wise and the shareholders of Wise are the same thing? As an accountant, we have a quantity concept, even in law. Can you say Wise? Okay, if, for example, now, if Wise owe you guys money and fail to deliver, can you now say it's Muiwa owing you money?
So what I feel is I just feel we don't want to assume. And
No, there's no assumption there. It is clear now. Please, can anybody justify that Susie PLC can be the same thing as the owners of Susie PLC? It's not. Therefore, it's not about assumption. There are some basic things as professional that is given. And that's why we continue to emphasize it. Do you get what I'm saying now? And two, when they give you date of acquisition, has nothing to do with who is transferring to who and for what purpose. That's why I've continued to emphasize that don't focus on trying to just grab the format or anything to say, okay, for example, now, if they give you the date of acquisition, it plays no role since they have given you what the position owed as at that date. For example, why do I need date of acquisition when they have already told me the reserve existing as at that date? What if they give me? It's of no essence at this moment. And secondly, information says on particular day, asset was transferred by the parent to Susie PLC. They didn't say to the investors or shareholders of Susie. They are two separate things.
So I guess that is where it's clear, because most of the questions we've been solving, it's not like we've actually have questions whereby they will say owners. So maybe that is why
No. Okay, which question have you solved that we have done transfer of asset to owners? That you
Yeah,
said most of the question.
you don't get what I'm trying to say. What I'm trying to say is that it's not like we've really had any question that actually said maybe owners of the company. We've always been doing Susie. So maybe that is why we are having that confusion of.
No. We are still missing it up. We are still missing it up. Please let us start to more or less focus on principle, not on the way you see things, not on the pattern of things. I'll continue to say it, and that's what ICANN is shifting away from. Because people over years are just format, just give format, put it here, put it there, without knowing what they are doing. Do you get what I'm saying now? All what we have done so far is relationship between two companies. The only time we have dealings with a company and the shareholders is at the point of acquisition, which we discussed yesterday, where we have to pay cash to the former owners. We have to give them shares. Remember, any other thing apart from that, it is now dealing with two companies, which is different from company and individual. Is that okay? But again, more of continuous practice and more of continuous learning. And that's why I've warned people that don't just go and carry textbook that is just question and answer. Because what you only be practicing is that, when you see that similar question, you answer it. But when they twist it, you're on your own because that principle and the underlining is not there. Is that okay? Okay, sale of profit on sale of goods now. That is where we are, and I want somebody to explain that.
Okay, sir. So can I go ahead?
Yes.
To get the profits on the sale of goods, we have to calculate using the cost of the goods times 20 times 20% that we are giving in the question, and it will give you 2 million as a profit.
Okay, now let me guide us now. Yes, even though you are right, but let me guide us for future sake. You know, we have discussed something about margin and markup.
Yes.
Now, can you tell me the profit in this question, how is it being expressed? Is it expressed as a markup or is it expressed as a margin? And tell me why.
It is expressed as a markup.
Markup, why?
Yes. Because in the question it says that the profit is 20% on the cost of the goods.
The question says what? 20%.
20% on the cost.
Look at it here. Can you see? PLC sold goods costing what? 10 million for what? 20% on the cost. Which means the expression given to us is margin. This 20% on cost means they gave us what? Markup. Sorry, not margin, markup. Now, but what factor you need to consider is that this 10 million given to you, is it cost or selling price?
Is the cost.
Is it cost? Okay. Therefore, can you apply markup to cost directly?
No, I think we have to do the...
No, you can't apply cost and markup directly. Who will assist? Daniel, you are putting something on the chat. Can you speak up?
Sorry, sir, the question again.
Yeah?
Yeah,
Daniel.
we can apply the markup on the cost, sir.
Why?
I think it's because of when we are, I think it's principle for the markup is matched on the costs and the margin is matched.
Because they relate together. Remember, markup is profit as a percentage of cost, which means they have something in common. Okay, exactly. What I'm just pointing your attention to is that what if the question changes and says, Pali PLC sold goods worth 10 million naira? That means they change the word cost to what or value. or selling price. Which means if this 10 million is no longer cost, but we still have this expression of 20% on cost, it then means that you have value or selling price and they gave you markup. At that point, you have a problem. The problem is that you cannot apply markup on sales value. What do we do if we are in that situation?
You can convert the markup.
To what?
I think we can convert the markup to margin in that case.
Margin.
Yes, that is what I'm explaining to us. Now, let us come back to our slide here. This is why I'm always emphasizing principle, principle, principle. Now, since we understand this relationship, you can also understand that peradventure you don't have the appropriate information. Let me share the whiteboard. If you have markup, which is profit as a ratio of what? Cost. And you need to convert it to margin. What do? The first thing is that you recall that margin is profit over selling price. And selling price is equals to cost plus what? Profit. Which means I can simply say margin is profit over what? Cost plus profit. Now, how do I convert it? Remember, in this question, I was told markup is 20%. 20% means 20 over what? 100. How do I convert it to margin? Profit is 20, therefore I substitute 20 here. Cost is what? 100, I substitute what? 100 here. Profit is 20, I substitute what? 20 here. What is it? It is 20 over what? 120. That means that this is now my margin that I've converted markup to. Now, conversely, let's say we have margin. Remember, margin is profit over selling price. We have margin of 25%, which is 25 over what? 100. Now, if we are to convert to markup, what do? Recall, markup is what? Markup is profit over cost. Now, since selling price is equals to cost plus profit, if I want to make cost my subject of the formula, I can say cost is same thing as what? Selling price minus what? Profit. Therefore, in that case, I can now say my markup is my margin, which is profit over selling price minus now profit. At the end of the day, I now have profit over cost, which means, remember, what is my profit? 25%. What is my selling price? 100%. What is my profit? 25, which means it gives me 25 over what? 75. This is the conversion. Any question on that? On how you can convert? And you know, you only convert when you need to convert. If they give you cost and markup, you don't need to convert, you apply it straightforward. If they give you sales value and margin, you don't need to convert. The only time you convert is that they gave you cost and they gave you margin, they can't match. Or they gave you sales value and they gave you markup, they can't match. Those are the period you convert so that you can compare apple with apple. Any question at that point? Any question at that point? Please, you can unmute and answer. Otherwise, move forward. Okay, now let us move forward. Now, in this case, my profit on sale is that I have information about the markup and I have information about the cost. I don't need to convert. I'll now do what? 20% times 10 million. That gives me how much? 2 million naira. Now, this 2 million naira, as I've said earlier, we now have to analyze it into portion realized and portion what? Unrealized. And the basis of apportionment is that the portion that was eventually sold by the subsidiary, the third party, is realized. The portion that remained unsold is what? Unrealized. Now let's go back to the question. The question says what? The question says that, can you see the last sentence? No, okay, the second to the last sentence says, as at the reporting date, only 40% of these goods were sold to external customers. Who can interpret that? What does that mean?
So it means only 40% of the profit has been realized, while the remaining 60% is still unrealized.
Yes, that is correct. Now, let me now tell you one secret in exam. You got it right 100%. Do you know what the examiner would do? Because probably in ICANN text, this is the expression they've used. In the exam, they will now change it as does. Listen to me. What they will now say is that as at the reporting date, only 40% of these goods were included in inventory of Suzy. I repeat, as at the reporting date, only 40% of these goods were included in the inventory of Suzy. What does that mean?
Hello, sir.
Yes, Adeleke.
Hello, sir. Okay.
I guess what it means is the same thing, like only 40% has been sold to external customers. When he said it is...
You are wrong.
Hello, sir.
Okay, sir.
Listen to
Hello, sir. It means that, hello, sir.
Okay.
Hello, sir.
In ownership of the,
Hello.
it's still ownership of the subsidiary. So 40%.
Hello, sir.
Yeah, you can talk. You can talk now.
It means that 40% of the goods in the inventory has not been sold.
That is correct. Listen to it very well. This is why I say we should understand principle. They said as at the reporting date, only 40% of these goods were included in what? Inventory.
In the inventory,
inventory? Yeah. Inventory means unsold goods. We need to be very, very what? Careful. Now, let me also rephrase it in another context. If they say as at the reporting date, only 4 million naira cost of these goods were sold to external customers by Suzy. They didn't give you a percentage, they gave you 4 million naira of these goods were sold to external customers of Suzy. What does that mean?
It means, hello, sir.
Yes.
It means that we are going to deduct 4 million from the 10 million, meaning 6 million out of those goods were not sold.
Now, which means that you convert that absolute amount of 4 million to percentage, which means if out of 10, 4 million was sold, what percentage is that? 40%.
Yes.
Which means they can come in any way. This is what I'm trying to avoid, so that when you get your exam, you say, no, they didn't teach us this one, no. They only told us once you see that percentage, it is what is sold. without reference to the information provided to you. 2, they might not give you percentage, they give you units. Like in this question, they told us 160 million shares acquired. Somebody will say, in the class, they always give us percentage. How come they are giving me 160 million shares acquired? How do I do that? It's because that person lacks understanding of how do you arrive at percentage? Is it not a measurement of absolute value that give percentages? Are you getting it now? And that is what I am emphasizing. So that you don't get to the exam, you just think that, every question we are solving in class, once they give you percentage, is the percentage of items sold. Whereas it is clear and staring at you that what they gave you is contrary. That's why you don't go into examination with your own question. You know, some of us will get to the examination, we are answering the question we set for the examiner, not what the examiner sets for us. Because what happened, most people that find themselves in that position have only successfully crammed to go and pour. And that's why you see that ICANN exams these days are very simple but logical. And it's only meant for people that understand, not people that have been solving question, cramming. That's why the same question I'm going to solve now, I can twist it in more than 10 ways that only those that really understand the principle will still know that it's the same thing I'm saying. Others will say, but they didn't teach us this one. That's why I said, never be asking for formats. Never be asking for mass attack. Never be asking for shortcut. Ask for knowledge, and the knowledge will always set you free. Okay, that means we'll go back to this question now. The main question says, only 40% of these goods were sold to external customers. Therefore, we analyze it as thus. If 40% were sold, it means 40% is realized. The portion unrealized is the asterisk, which is what? 60%. Which then means that my concern is that these 2 million my concern is that this 2 million, what portion of it is unrealized? That's my concern, which means my concern will now be unrealized profit on inventory. Unrealized profit on what? Inventory. My unrealized profit on inventory. Now we have done it. You said out of 2 million, 60% of it is unrealized, which means my unrealized profit will now be the ratio, the percentage of unsold goods, which is this 60 what? Percent multiplied by what? 2 million. And what is 2 million? Profit on sales. Would give me how much? 1.2 million. Any question at this level? Any question? Daniel said we don't have to convert back to percentage. Yes, you may not convert back to percentage if you know how to navigate your way. But if not, convert it to percentage and use that percentage to determine your unrealized profit. Any question at this point?
Sir, please, I have a question.
Yes.
Okay, so my question is, in the case of where they give us numbers and say, okay, 4 million or
We can't hear you. Hello? Okay, any other question for anybody? Any other question? For you that might have problem with your network, it's better you type your question on the chat so that I can read it out and answer. Okay, now, what do we need to do? When you have unrealized profits, how do we treat it? It's for you to understand that that profit was included in the profit of the subsidiary, of the parent. Remember, who sold to who? This goods was sold by who? Sales made by parents. Later on, I'll come to describe how we consider such sales made by parents. Now, the parent made the 1.2 million naira, of which 1.2 million naira of it is unrealized. What then do we do? Is for us to take it out of the profit of the parent because it is unrealized. And if you go back to the inventory of the subsidiary will have been overstated because the subsidiary is supposed to be sold to at cost, but the parent has made profit on it. Therefore, the subsidiary is overstating it above cost. And remember, IS2, which is on inventory sales, you recognize inventory, whether for a single entity or for a group, at the lower of cost or net realizable value. Now, the cost is not inclusive of 1.2, but this has been done because the parent has added that profit. Therefore, what do? We also go back to the inventory of the subsidiary to remove that profit element from it, which means our accounting entry will be as follows. The unrealized profit will be removed from the parent's profit because the parent sold the item. And it will also be removed from the inventory of the subsidiary because the inventory has been overstated by that same amount included by the parent. And this is the entry we pass for unrealized profits. And this entry only affects transactions made by the parent to the subsidiary, which means sales made by the parent to the subsidiary is otherwise known as downstream transaction. As what? Downstream what? Transaction. Why is it downstream? If you recall, the parent is always on top and the subsidiary is always what? Below. Which means somebody dealing with somebody on top, dealing with somebody below, is looking down the stream to deal with you. And that is what that implies. Okay, that is that. Any question at this point? Remember, the first transaction we have dealt with is intercompany sale of what? Goods. That is all. Any question on that before we move to transfer of plants? Ekemeze, Oya, can you unmute and answer?
Okay, I have a question on the accounting entry.
Yes.
You said will debit the group account.
Why are we debiting it? Because that profit has been overstated. Remember, the 2 million was already recognized. And we're not saying out of the 2 million, 1.2 of it is not realized. Therefore, what do you have to do?
Yes, I actually understand that. My question is on the inventory. Since this is the profit, I thought we're supposed to credit the amount of goods in that was
do what?
The amount of the goods, of goods that are yet to be realized. I thought that is what we're taking to the inventory.
That's 1.2. No goods that you have not sold will be your inventory now. But inside that amount of the goods, there is 1.2 million added to it. That's why we are removing it.
Okay.
Did you get it now?
Okay. Are you actually saying we remove the 1.2 and also the and also the 6 million worth of goods that is yet to be delivered?
No, you are not removing 6 million now. What we are saying is that you, the subsidiary, you are carrying inventory, which means unsold goods, but the amount you are carrying it is overstated because you are not privy to understanding that there's a profit the parent has loaded on it, which has not been realized. You have to remove it because it is overstated.
Okay.
Remember, the responsibility to prepare account is the parent, and the parent is aware of what he has done. And you know, you can't deceive yourself. You have to go back and remove that amount as at the reporting date. You left the amount there with the expectation that the subsidiary would have sold it to third parties. But unfortunately, the subsidiary was unable to do that.
Okay, sir, I understand now. I was actually doing it the other way around because I looked through the question yesterday, but I was not able to understand this place. So I think I had to make use of the amount of the goods instead of the profits. So
no, it's a profit. What you're eliminating is unrealized profit, not the exact transaction.
Okay, sir, thank you.
Yeah. Tunde, you want to say something?
Yes, sir. Yes, sir. I just want to confirm. Does it mean that it is at the point of consolidating the group inventory that you deduct the 1.2?
Yes, sir.
Okay, sir.
Every adjustment we are making is only at the group perspective. It doesn't affect the entity on individual basis.
Okay, sir.
Remember, there are 3 accounts now. Separate financial statement for the parent, individual financial statement for the subsidiary, and consolidated. Consolidated is all of what we are doing. It does not affect those individuals. This is just at the group level that is confining.
Okay, sir. Thank you very much, sir.
Yes. Okay, now let's deal with the second level. The second level is what? Can we mute? The second level adjustments. Is on sale or transfer of what? Plants. By who? By parent to subsidiary. And if it is by parent subsidiary, we still call it what? A downstream transaction. Take note of that. Now, let's go back to the question. If you come here, we're told that as of 1st of January 2014, that was 2 years to this time. You have to count it from January 2014 to 31st December 2015. That's exactly 2 years. Pali transfer plan to Suzy for 40 million. That means it transfer it, it dispose it off for 40 million. But as at the time it disposed it off, the book value was 36, which means as at that time, the company would have recognized profit on disposal of assets of how much? Who can answer that? How much will have been the disposal, profit on disposal of assets? Who can answer that?
I guess 4 million.
4 million, yeah. Okay, somebody said something. Is it compulsory to show entries in the exam? That is the accounting entry. It is not compulsory except otherwise required, but it is necessary so that you can know what to do at every point in time. In the exam, you don't put everything in your head so that when you now get to balance sheet to consolidate, you can't remember what you need to do. Okay, that's why anything you want to do, always try to define it as a process. so that even if there's error, you can easily trace it back. Otherwise, you do lost. It is after exam, you now remember that, it is this thing I'm looking for, but it's too late as at that time. Okay. Okay, now that is that. Now, this is it. The next information there is that the remaining useful life of the plant is what? 10 years. And this was as at 2014 when the plant was what? Transferred. Okay, we'll come back. The first level is that I need to determine unrealized profit. On the transfer of plants. And to do that is very simple. You ask yourself, what was the transfer price or disposal price? It was transferred for 40 million. And to determine disposable profits or disposal profits or profit on disposal, you consider the difference between your disposal price and carrying amount, which is what? 36. And you discover that the profit the parent had made was 4 million. And this disposal profit or profit on disposal is considered to be what? Unrealized. Why is it unrealized? Because you are selling something to yourself. Even though as an individual entity, you have made profit, but when you now come back to sleep in the same house as a family, you have not made profit because the money is still coming within that family, and therefore it is unrealized. And remember, it then means that in the profit of the parent will have overstated the profit. Therefore, what do? You remove it from the profit of the parent. That's why you are debiting it. Okay. That is 4 million. And you remove it from the value of the assets of the subsidiary because it will have been overstated. Similar to what we have done under inventory. But as I've explained at the introductory stage, it doesn't stop here because the subsidiary that bought the asset for 4 million for 40 million have 40 million in his book and is depreciating that asset on the basis of 40 million. Remember, he has 10 years useful life from that point. It then means that in that scenario, we'll be depreciating it 4 million per year for 10 years. But from the group perspective, we are saying that no, it is not 40 million. That 40 million is fictitious because the parents loaded it with 4 million that's not realized, and we have reversed it. But it's still maintained in the books of subsidiary at 40, which will have influenced this depreciation chart. Therefore, what do? Every year, we keep track of that excess depreciation that was charged. Because if they have transferred it at the kind amount of 36, they will have been charging depreciation of 3.6 million. How do you arrive at 3.6? 36 million divided by 10 years means it will have been charging 3.6 per year. But which means he's charging, the actual depreciation charge is 4 million. But what's supposed to be charged is 3.6. It then means that he has more or less overcharged by 400,000 per year, which is 0.4 million naira. And that would have suppressed and that would have understated the profit of the subsidiary. Therefore, what you have to do is to go back and resuscitate and restate the profit of the subsidiary, and likewise go and adjust it against the overstated position of the plant of the subsidiary. What it simply means is that the second adjustment will be depreciation adjustment. Now, since There are two ways of doing it. I'll show you the approaches. Approach one. What will be the depreciation charge based on transfer price? Remember, if it's based on transfer price, they transfer at 40 million. And if they depreciate for 10 years, which means 4 million per year. And let us check, since the date of acquisition to date, on 1st of January 2014 was when the asset was transferred. And today is 31st of December 2015, which means the subsidiary that bought the asset will have depreciated for 2 years. Namely, first depreciation will have been done between 1st of January 2014 and 31st of December 2014. Second depreciation will have started from 1st of January 2015 to 31st December 2015, which make up 2 years. Which means if you recognize depreciation of 4 million for each of the year, for 2 years now, you'll have charged 8 million. Instead of you to have charged how much based on the carrying amount? Based on the carrying amount, you should have charged 3.6 million per year, which is as a result of 36 million for 10 years, which is now divided by 10. Now, in that situation, what happens? 3.6 million per year for 2 years, what you should have charged is 7.2 million, which means each of the years you have overcharged by 400,000, which means for 2 years you have overcharged by 800,000, which is 0.8 million naira. This amount is what constitutes your excess depreciation charge, which you now have to what? Adjust for. Alternative way of doing this is approach 2. And this approach 2 only assumes that you use a straight line method, which says my 2-year depreciation adjustment is, remember, 2 years have gone out of 10 years, which means my adjustment will only be fractional part of the 10 years, which has passed. And the fractional part that has passed is 2 years. Now, the whole essence of this difference in depreciation is nothing other than the issue we had by transferring above the carrying amount, which is 4 million. If you have transferred at 36 million, it then means that nothing would have caused the adjustment. But you didn't do this because you are a separate entity, you carry it out at arm's length. We said, oh, no problem. That is a legal form because you are a separate entity. But the substance is that as a group, we expect you to have done it at the same amount because you need not to have created the value within yourself. And therefore, it means that this 4 million is the only source of the difference that is affecting all of this up to the point of depreciation. Therefore, it then means that rather than work on this part, I'll say this 2/10 as an adjustment of 4 million should give me the 800,000, straightforward. Again, when you look at it as a mathematics student, you find out that there are things in common here. What are the things in common here? 2 years is in common, which is what we brought here. And what is also in common? 10 years is in common, and that's what we brought here. What is less in common? 40 and what? 36. And the difference between 40 and 36 is this 4 million. Does it make sense now? Any question? Now, any question before I move further? For people that always consider time as a factor in the exam, once you have the understanding, you can use approach 2. Olamide? You can go on.
Yes, sir. Well done, sir. I'm clear with this depreciation adjustment, but I'm a bit confused about the accounting entry, the credit side. Like you said, debit, that we should debit group profit, like removing the profit from the group because it was overstated. Can you explain the credit, like the credit part of it?
The credit side is that the plant that the subsidiary is carrying it at 40 instead of 36, which means the plant is overstated. Go and remove the 4 million. So that when you remove 4 million for 40, you bring it back to 36.
So we are removing it from the group profit too?
Not profit, plants.
Okay, plant rather.
Yeah, because the plant is 36, but you are reporting it as 40 because of you sold it at 40. And I say, no, you didn't sell to external party, you sold to yourself. Therefore, remove that 4 naira away from it and bring it back to what it's supposed to be.
Okay. So we bring it back to the group plant by
It is already in
crediting
group plant. It's already in group plant, but it's there at a wrong value of 40 instead of 36.
Okay.
What then do? You remove that 4 that is wrong out of the 40 to bring it back to 36.
Okay. Thank you.
Okay, now let me come back to the accounting entry. For every adjustment, you must know account that will be affected. Now, if you have overcharged depreciation, the person that is affected is the person that carries the asset in his book. Who is the person that carries the asset in his book now? Is it the parent or subsidiary? Who can answer that? Subsidiary. Therefore,
Subsidiary.
The profit of the subsidiary has been suppressed, has been reduced. Okay, therefore, what you have to do, you have to go back and restate the profit of the subsidiary. But remember, if profit of subsidiary has been suppressed before now, who do you believe ultimately are affected?
Hello, sir.
Yes.
NCI.
Sorry, I don't. But I guess the
NCI
are affected.
You are making a mistake. Who ultimately will be affected if anything happens to the subsidiary's profits?
I think the parents will be affected because they are the ones in charge of the subsidiary too.
We are still making a mistake. Okay, let me ask you, who are the owners of the subsidiary?
The parents. That is
parent and SCI.
Exactly. Please let us process things. Okay. The shareholders of the subsidiary will be the ultimate beneficiary or ultimate person that takes that burden. The next question we'll now ask ourselves is that who are the shareholders? Who are the shareholders in the subsidiary?
Parent and NCI.
Exactly. Which that means that anything that affects the profit of a subsidiary eventually will affect who? The shareholders, which are the parent and subsidiary, which means a reduction in the profits of a subsidiary brings about a reduction in the distribution of return to shareholders. An increase in the profit of subsidiary brings about what? An increase in the return to who? To the shareholders. That's what we need to understand. Now, since we have understated the profit of the subsidiary, it then presupposes that the shareholders, which is the parent and NCI, are suffered before. Now we have realized they're suffering and we have to restate them to what they're supposed to have, which means we are coming back to increase that profit of subsidiary by way of an adjustment because they have been overcharged. And doing so is that I will come back here to increase the value of the plant because when you overcharge depreciation, what you simply do is that you understate the value of the plant by how much? 800,000, which is 0.8. Now, correspondingly, it affects subsidiary's profit by restating it upward, and that will affect both the parent through the consolidated reserve and what? The NCI. And remember, parent and NCI are affected in the ratio they share profit or what? Or loss. Now, 80% and what? 20%. Now, somebody will ask me, how do I get 80% when it was not given in the question? Who can tell me how I got 80%? Yes. How did I get 80%?
Hello, sir.
Yes, ma'am.
You divided how to get the 80% for the parent company.
Yes.
The number of shares acquired divided by the number of shares of the subsidiary. Then you divide it by the nominal price times 100/1.
Yes, that is where we are going to now. That shows that you are following. Which means now let us now start to solve the question. The main question we have solved is the adjustment, which is the new thing we have learned. Now, what we now want to do now is, they didn't give me the percentage. I have to look for it myself. Therefore, we look for percentage holdings. Abi, you acquire how many shares? 60 million shares. 160 million shares. Out of how many? They didn't give us the number of shares in the parent, in the subsidiary, but they gave us the share capital of the subsidiary. What is the share capital of the subsidiary?
100 million.
100 million.
100 million.
The share capital of Suzy is 100 million naira. And the nominal price is 50 kobo per share. Therefore, the number of shares
100 million.
in Suzy will be what? The share capital divided by the what? The nominal price, which is what? 100 million naira divided by 0.5. That gives me what? 200 million what? Shares. Which means, what is the ratio of 160 million you acquired to 200? That gives me what? 80%. And on that basis, we say there's control. I can now say my group structure recognizes the fact that Pali acquires what? 80% in what? In Suzy, with NCI of what? 20%. What is my date of acquisition? Sometime in the past, Abi? In the past, we are not given, and it's not relevant, since they've given me my pre-acquisition reserve on the platter of what? Gold. And my reporting date is what? 2015. This is why you start to know that not necessarily because you have been given information in the past, it is relevant. You understand? The day they don't give you, you now look confused. It's because over time, you've not discovered whether those information are just mere noise, are just mere information that does not necessarily add or remove what? Value. Now, what then do we do next? Is for me to determine my pre and post acquisition reserve. What is the reserve of Suzy as at the reporting date? If you go back to the question, the reserve of Suzy as at the reporting date is 60 million. And we have to split it into two. Reserve as at acquisition date and post what? Acquisition profits. Reserve as at acquisition date is what we call pre-what? Acquisition. And we are given information that as at the date of acquisition, let me share this slide. As at the date of acquisition, when 160 million shares were acquired, the reserve stood at how much? 120 million. Okay, if that is the case, I come back here to say this is 20 million. And between acquisition and now, my reserve has grown from 20 million to 60, which means it has created positive return of what? 40 million. Now, on that premise, we can go ahead to carry out our goodwill assessment, if any. Goodwill. What is my cost of business combination? Pali's investment in what? In Suzy. How much is it? How much?
It's 80 million.
Where do you see 80 million? We are making 80% and 80 the same thing.
100 million.
Thank you. NCI, we have to measure it. What is our fair value of the identifiable net asset acquired? I remember that can be obtained through my share capital and my pre-acquisition what? Reserves. What is my share capital? It's 100, Abi. My pre-acquisition is what? 20. That gives us what? 120. Therefore, NCI is what? 20% of 120 million. That is 24. Remember, we said the investment of the parent plus NCI, which is 124, compared with the net asset of subsidiary, give us a goodwill of what? Of 4. Now, NCI. For the first time, I'll introduce you combining NCI and consolidated reserve together. I can use one stone to kill 2 birds. And this is as at the reporting what? Date. Consolidated reserve and what? NCI. Now, Pali's reserve is an input to consolidated reserve, and that is 140. It has nothing to do with NCI. 2, the value of NCI as at acquisition date has nothing to do with consolidated reserve. And that value, from the information we have here, is 24. We bring it under NCI. Now, NCI and consolidated reserve have something in common. What they have in common, they have to participate in this profit, post-acquisition profit, which we share to them in ratio 80-20. I'll now come here, as part of those adjustments, is share of Suzy's post-acquisition what? Profit. And that is what? Ratio 80 to what? To 20. Of how much? Of 40 million. 80% of 40 million is 32. 20% is what? 8. An addition. Now, what are the adjustments we have? Remember, if you don't pass the entry, you won't be able to recall. This is where the problem comes in the exam. You might forget what to put there. Remember, I said I should reduce my profit by 1.2. Abi, group profits. I quickly come here. I'm to reduce group profit by 1.2. Why? It doesn't affect NCI in this case. Why? Because of unrealized profits on inventory. The second adjustment I have, remember what I did here, I circle it, which means I've used that 1.2. I still have 1 left, but that one is a balance sheet item. I'll take it to balance sheet. Second adjustment I have is unrealized profit again on plants. I also have to reduce my profit. That is 4. It has nothing to affect NCI. Unrealized profit on plants. I do that. Which other adjustment I have again? Depreciation adjustment. If you remember, and that depreciation adjustment affect both parent and NCI, 0.64 and 1.1. And he said I should credit it because the subsidiary has been over depreciated. Okay, with respect to plants. Therefore, I'll come here. Adjustments, excess depreciation adjustment on plants. Remember, I'm told to credit. Credit means add to both NCI and to the parent. Which other adjustment is left? There is none left. Okay, all things being equal, I can sum this up. And let's pick our calculator and sum this up. $140 plus 32 minus 1.2 minus 4 minus
SCI
plus 0.6. Please confirm whether my own figure is also correct. 167.44. And this one is what?
32.16. 32.16.
24 plus 8 plus 0.16. Please confirm. This is 32.16.
Yeah.
Exactly. Are the two figures correct?
Yes.
Okay. Now, let's now prepare our balance sheet. Pali Group. Consolidated statement of financial position as at 31st December 2015.
Correct, sir.
Please, if your network is poor, kindly send a chart. Okay, assets, non-current grouping. The first item we have is PPE. Now, what's our PPE? We have 110 for the parent and 120 for the subsidiary. But don't forget, we have adjustment that affected PPE.
Yes.
The first adjustment that affected PPE is this 4 million, which we said we should use it to reduce the overstated amount of plant, which means I'm going to minus it. Where's my PPE disappeared? Okay. PPE. 110 plus 120. Now we said we should minus 4. Okay. What other adjustment do we have? We have adjustment for the excess depreciation. Okay. Which is this 0.8. Because the asset has been over depreciated, we have understated it by 0.8. What do you have to do? We add it back by increasing it, which means you come here, you say plus 0.8. These are the corresponding adjustments. And when you add them together, it says 110 plus 120 minus 4 plus 0.8. That gives me
226.8.
226.8. Now, what is my goodwill? My investment cancel out, leaving out goodwill. What is my goodwill? 4. All things being equal, I have 230.8. Now, next is current assets. We have inventories. And there I have 40 and 45. But I'm aware there's an adjustment that affected my inventory. That was the first adjustment. Remember, that adjustment is unrealized profits. And I said I should do what? I should reduce my inventory value because it's overstated by 1.2. I come here and say minus 1.2. What does that give me? 45 plus 40 minus 1.2, that is 83.8. What next? I have receivables. My account receivables is 15 and 12. That is 27. And I have bank. And my bank is 5 and 7. That is 12. If you add it together, a 3.8 plus 12 plus 27, I have 122.8. 122.8 plus 230.8 will give me 355.6. That gives us our total assets. Now, this total asset is financed by equity and what? Liabilities. And my equity can be divided into share capital and reserves. What is my share capital?
80.
It's for Pali alone, which is what? 80. What is my consolidated reserves? My consolidated reserve, as done above, is 167.44. $167.44. When we add it together, that's 247.44. That is the equity attributable to Pali. The next is equity attributable to NCI. And that one is 32. You saw it there. That's 32.16. That's 32.16. Can we add it together? Somebody should give me the value of total equity. 32.16 plus 247.44. That is 279.6.
279.6.
Now, what next?
Current liability.
What next is my current liability? My current liability is what?
50 plus 24.
50 plus 24.
Plus 24.
That's what? 74. All things being what? Equal. What's my total equity?
353.
And liabilities.
353.6.
35 what?
353.6.
0.6. That is all. Any question? Any question on that? Let me do you one favor. Let me first of all save it and send it to you so that you can also have it before we solve second question, which is similar question. Any questions so far?
Yes, sir, I have questions, sir.
Okay, what's your question, sir?
Okay, I lost network for a while. That was around the unrealized profits. I want to understand, are we assuming that when we transfer the plant to the subsidiary at 40, that was the amount they used basically as like their cost in depreciating in their books?
Yes, sir. Because you as a buyer, is it not the cost, the amount you pay for an asset that you bring to your books as the cost? That is what they did. But we are now saying that when it now comes to consolidation at group level, we know that at group level, they're supposed to move asset at the same amount. Therefore, that's why we are carrying out the adjustments. Is that okay, sir?
Yes, sir.
Yeah.
Also, can you please help me
Okay, hold on.
explain?
First, I've sent the stuff to the chat. You can download it now. Okay.
Right, sir.
Yeah.
Can you just help me explain why you debited the group profits with the 4 million? Like, what's the rationale behind that?
The group profits.
Yes, sir.
Remember, the parent that made that profit had already added that profit to, okay, let me show you something here. Let me show you something so that I can see it clearly. Look at it. This 140 million. Can you see this 140 million? Eh?
Yes, sir.
This 140 million of the parents already included the following profits. It included this 2 million naira you are seeing. It's part of that 140 million. We are now saying that out of the 2 million that is part of that 140, 1.2 of it is unrealized. That's why we are removing it. That's why you see that it's out of this 140. It's out of this 140, we are removing this 1.2. Similarly, it's out of that 140, we are removing this 4 because when the parent sold that asset, he made 4 million naira profit on disposal of assets, which is part of this 140. We are not saying that, no, that 4 million naira is not realized. Remove it out. That's what we have done, sir.
Okay, sir. Thank you, sir.
Somebody said, why is 50 kobo per share not having effect on Pali share capital? I didn't understand. What effect should it have? I didn't get it. Olamide, what are you trying to achieve? I'm not getting your question.
I mean, in a consolidated financial statement,
Yes.
like we just put, I thought it should be like 80 million divided by 0.50 or so.
And we'll put it where?
We just put 80 million directly.
Is the naira value you are putting now? Do you want to put shares in your balance sheet and add it to value?
Okay. That's true.
You understand what I'm saying now? It's naira and kobo you put in your balance sheet now. You don't put, it's like your motor vehicle. You now put the amount of cash you have in the balance sheet. It's the value of those cash you put in the balance sheet. Is that okay?
All right, sir.
Any other question? Okay. Now, since you've had the download, I want somebody to read this question out, and that same person or any other person can assist to say, what is the difference between question 13 that we just done and this question 14? Please, I'll give you 1 minute. Let all of you read it. Somebody should read it out and the other people digest it. And in 1 minute, you tell me, is there a difference between question 14 and 13? And what is the difference? Who want to read for us?
Pali PLC, I'll read.
Okay, continue.
Pali PLC acquired 160 million of the shares of Suzy PLC when the reserves were 20 million naira. Suzy PLC transferred plant to Pali PLC for 40 million naira and has a carrying value of 36 million naira as at the transfer date, January 1, 2014. The group has a uniform depreciation method for the same class of assets, which is a straight line method. The remaining useful life of the plant is 10 years. During the year 31st December 2015, Suzy PLC sold goods costing 10 million naira at a profit of 20% on the cost to Pali PLC. As at the reporting date, only 40% of these goods were sold to external customers by Pali. In the same period, the statement of financial statements of the dual companies as at 31st December 2015 was as follows. Prepare the consolidated statement of financial position as at 31st December 2015.
Okay, can anybody now tell me, are the questions exactly the same? And if not, what is the point of difference in those questions?
The question here, they are not the same. They are exactly the same, but the difference here is that the subsidiary is the one now selling to the parent company.
Thank you very much. Now, that is one. A problem identified is half solved. The next question is, what implication does that have in trying to solve the question? Will it change what we have done before?
It's like a reverse.
Yes.
Are you sure?
Where you?
It's going to be like an upstream transaction or something.
Forget issue of upstream or anything. Don't let us focus on cramming or any information. Let us look at it from ideological, something natural to explain what has happened. That's how to learn. Otherwise, if you are just cramming upstream, downstream, it's like you are just cramming it. Let us narrate it down like common man. Okay, what effect will it have?
Sir, can I say something?
Yes, say something, madam.
Okay, what I understand now is that since it's the subsidiary that is selling to the parent company,
yes,
the reserve now of this subsidiary will have to be the unrealized profit. After calculating it, you have to remove it from the subsidiaries from the reserve of the subsidiary company.
Mm-hmm.
Then you also debit the non-current assets in the consolidated account. I don't know if I'm correct.
It's for you to try.
That's what I understand.
Okay, who else? Who else?
Sir.
Yes, ma'am.
From my understanding, I think since it was Susie that was making the transaction, we might have to share the profits or anything that is accruing to them between the parent and the NCIO holders.
Okay. Who else again? Who else? Who want to contribute? Who want to contribute for the last person that want to contribute so that before I move further?
For me, I think since it's still a consolidated account and it's going to affect, and it's actually the parents that is still the owner of subsidiary, they are consolidating. But I only think maybe where the difference will come in is the depreciation expense. I don't know.
Okay, some of you guys have given idea of it. Now, the first thing I want you to know is that, let me show you what I'm doing at the back end here that you guys are not privy to. I'm sharing it now. I've copied the exact solution I made in question 13. I've copied it here as question 14, and see what I'm going to do. And I'm going to explain it one by one. Okay, I'm going to try to clean up some things here. And in doing so, I'm trying to do something and I don't know why. No. Okay, now I'm going to do this. Just follow me through. Now, in this case, sales was made by the subsidiary, not the parent. And I'm going to take away this, and I'm going to come back to that. First, what am I trying to do? The transaction here is made by the subsidiary. Okay, and in that case, we call it upstream, and I will explain. Upstream means that somebody that is under you is the one now initiating transaction to you, which means somebody downstairs is looking up to somebody upstairs to initiate a transaction. We call it an upstream transaction. Okay, now, what is the implication of that is that it still doesn't change we identifying unrealized profit and etc., but it affects our accounting entry. And therefore, what I'll do is that under this accounting entry, what is the issue there is what the second to the last speaker has explained. And I will explain it once again in case you didn't get it. Who sold goods here is the subsidiary. Who has made that profit is the subsidiary, which means included in the profit of the subsidiary is this 2 million naira. And we are saying that out of the 2 million naira, 1.2 million naira is not realized. And don't forget, the subsidiary will have shared this profit to the shareholders, which is the parent and the NCI. Now, we want to retrieve back the 1.2. If you wrongly share money to people, and later realize that you have overshared to them, what do you do to them? You call them one by one to say, this is the portion I've overshared to you. What do? Return it. Is that right? Does it make sense? Does it make sense? Can we talk?
Yes, it makes sense.
Yes, sir. It is.
Yes, sir, it is.
Yes, sir.
The subsidiary before now thought that profit is realized and it has shared it. Later, I found out that 1.2 of it is not realized. I have to now go back to those that I've shared to and call them back to say, I've shared 80% of that 1.2 to you, please return that. I've shared 20% to you, please return it. Which then means that in this case, it is not only the parent that will be affected, because anything that affects the subsidiary affects the shareholders. And the shareholders in this case are who? The parent and the what? STI, which means parents will only be affected to the tune of 80%, while NCI will be affected to the tune of what? 20%, which means 80% of that 1.2 million is what affects the parent. Why 20% of that 1.2 million is what affects the NCI. How much is that, please? 80% of 1.2. That's about 960,000. That's 0.96 million. And 20% is about 240,000. That's 0.24 million. Now, invariably, the inventory value is not different from what we have done before, which means the 100% of it will still affect our what? Inventory, which is 1.2 million. Now, what is the effect of that? Look at what I'm doing. The effect of that is that where before now, I assume that it only affects, the 1.2 million before only affected the parent. But now it's affecting not only the parent, but it's affecting what? Both the parent and the NCI. Therefore, which means I have to come here to erase this, that this 1.2 will be borne by, let me use another color to show it, will be borne by both the parent and the NCI. And we have said the parent will suffer 960, the NCI will suffer what? 24. Which means the 1.2 million is now divided into 960,000 and 240,000. That is first leg. Now, the second leg of adjustment is that we had intercompany transfer of assets. Again, who transferred in this case? I also come back here, who transferred is not the parent. It is who? The subsidiary transferred to the parent. Therefore, in that case, we won't call it a downstream transaction. Rather, we'll call it what? An upstream transaction. Now, in that case, who sold plant to who? The subsidiary sold plant to the parent for how much? For 40 million, which means he has made 4 million, which means included in the profit of the subsidiary that has been distributed is 4 million that's unrealized. Therefore, what will happen? The same thing will happen is that you have to go back to the shareholders, which is the parent and NCI, to collect back the excess amount you have shared to them. Therefore, what do I do? That I come back here again. And recognize that fact. What is the fact? My accounting entry. The debits will affect both the parent and the NCI ultimately. The parent will suffer for 80%. NCI will take the burden of what? 20%. Whereas the entire credit will be a reduction in the group plans, which is the 100% amount, 4 million. Now, the 80% of 4 million, which is 3.2 million, will affect the parent, and 20%, which is the balance of 4 million, which is 800,000, will affect the NCI. In that light, we come back to say, which means where it only affects the parents, we come here to say, no, this 4 million that affected the parent only before is no longer the parent, it's both the parent and what? NCI in the proportion they share profit or what? Or loss. Therefore, I'll come here to change the position here to the fact that it's not only affecting the parent, it's affecting both in the proportion they share profit or loss. The first one is 3.2. The next one is what? 0.8. And finally, depreciation also. Who is carrying the asset in his book in this question? Who can answer that? Who is carrying the plant in his book? Who can answer this? Who is carrying the plant in his book? Adekunle?
Parents.
Parents. Who has depreciated the plant? in the book?
Who has or who is?
Who has depreciated the plant in his book?
The parent.
The parent.
I think it's Susan.
The subsidiary has depreciated before selling.
Somebody has sold 4 years ago. We are talking of depreciation that happened in the last 2 years. You are still talking of. You say, okay, who bought plant? Who bought the plant?
Parent.
Over 2 years now, Abi? Who has been depreciating the plant in the last 2 years?
Parent.
Yes. Now, we are now told that the parent has over depreciated. Whose profit has been affected by that over depreciation?
Profit of subsidiary.
Profit
of shareholders.
Profit of parents.
Of the parent, Abi?
Yes.
Okay. Now, who are the shareholders of the parent? What I'm trying to explain to you here is very simple. Is the parent profit that is affected here because it's the parent that is carrying the assets? And therefore, NCI has no, NCI does not even exist in the parent company. Remember, NCI are other shareholders like the parents. The only thing that brought them to common is the subsidiary, which means anything that goes on within the parent affairs alone has nothing to do with NCI. Which then means that this depreciation that has been overcharged, which we need to reverse, has nothing to do with NCI, because all of this happened in the books of the parent. That's what I'm establishing. Which means in this case, NCI has nothing to bear in all of these adjustments. Nothing like 80%. The adjustment is on the books of the parent where the depreciation has been what? Overstated. Which means you come here to affect it. Which means the subsidiary sold goods, sold plant to the parent 2 years ago. Anything that happened to that plant subsequently only affect the parent because the parent is the one in custody of that asset. But if it's the other way around, which is what we did earlier, it is the what's it called, subsidiary that adds recourse to it, and anything subsidiary have recourse to still affect the parent and still affect what? NCI. But in this case, anything that affect the parent solely affect the parent only, no other person's business.
Okay.
Are you getting it? That's what I'm saying. Now, in that case, now we now come here to say, year before we adjusted both the parent and NCI, but we later recognized that in this question now, NCI has no business in it. Rather, the whole effect of that depreciation adjustment of 0.8 should solely be that of the parent. In that case, what then do we do? We need to now redetermine what is our amount of consolidated reserve and NCI, which means we say 140 plus 32 minus 0.96 minus 3.2 plus 0.8. That gives me 168.64. 24 plus 8 minus 0.24 minus 0.8, give me what? 30.96. Now, one thing you need to do is that when I give you this solution, you will find out that the difference between this first solution and the second solution lies here, in the treatment we have here. Which means it's like what's an opposite, depending on who is selling to who. Is it upstream or downstream transaction? You see that here we have, for unrealized profit on inventory, we are sharing it to both parent and NCI, even for plants, but asset depreciation is only parent. Let us come back here to the first one. First one here, you find that for unrealized profit on inventory and plant, we only attribute it to the parent. While the excess depreciation, we attributed it to the two. That is just it, just because of the factor that distinguishes between the treatment of a downstream transaction from what? An upstream transaction. I have practical 8 examples in my textbook that treated it one by one at various instances. You can equally read it up in the textbook, which I called Contemporaneous Accounting for Business Combination and Group Accounts. Okay, that is that. Now let's now see the balance sheet. What has changed in the balance sheet is not material, but in terms of marks, it is material. Now, nothing affected the asset line. The only thing that changed is these 2 lines, because those transactions are transactions with owners of equity, which means what only changed is the following. This change, our retained earnings change, which will automatically affect our equity of Pali, and NCI change. But you find out that the total equity will not change. Why? Because it's a redistribution only between NCI and the parent. Okay, when you check it now, I have 168.64, 168.64, and I have 30.96. If you add this together, this is 248.64. When you add it together, you still get 279.6. Does that make sense now? Which means somebody will say, but even if I make that mistake, I'll lose. You will lose substantial mark, because I've told you earlier, the critical things that they will mark here are the following. This is the first critical thing that will be marked. This is the second critical thing that will be marked. This is the third that will be marked, and this carries the highest mark. And this is the last thing that will be marked. And if this is a 30-mark question, I can tell you that this alone can take like 5 marks. This can take like 3 marks. This can take like 10 marks. And this can take like 6 marks. Which means that you need to be very careful about missing them. Does that make sense now? Any question? Any question? Now, what I'll do is that I will save this again, and I'll override the first one I gave you. I'll give you 5 minutes to look at it and come back to the next phase of the class. Let me try and save this. Okay, I've sent it to you guys. You can look at it in 5 minutes and let us continue from where we stop. Okay, we are back at intercompany transactions. And at this level, what we are going to consider is intercompany balances and what we need to do with respect to eliminating intercompany balances. And as I've said earlier, transaction between the parent and the subsidiary may result in one party owing the other. The party owing will record a payable in his book, and the party expecting money from other will record receivable in his book. And on that premise, they constitute intercompany balance, what some people might summarize as current account balances within the group. But regardless of the name you call it, regardless of the nomenclature, what matters most is any balance owed within the group between the parent and subsidiary constitute an intercompany balance. And what we need to do, as earlier explained, is that such balance have to be eliminated upon consolidation of the account of the parent and the subsidiary. Now, the first premise we start with is to assume that the balances are in agreement. What it simply means is that if the parent says receivable from subsidiary is 10 million, the subsidiary should also say payable to the parent is 10 million. If we are in that trajectory, we say the intercompany balance is in agreement, and we can proceed straightforward in eliminating such intercompany balance. Okay, and that is the first level we need to consider. Doing that, we are going to look at illustration 15, which we have here. Can somebody read illustration 15 and let us solve it?
Illustration 15.
Pali PLC acquired 160 million of the shares of Suzy PLC.
Since the incorporation of that company, the statement of financial position of the dual companies as at 31st December 2015 were as follows. Prepare the consolidated statement of financial position as at 31st December 2015.
Can you list the item there, which is very key for us? I don't need the value, just list the items there.
Product, plant, and equipment. Current assets, inventory, trade receivable, current account to Suzy, bank, equity and liability. We have ordinary share at 50 kobo per share. We have retained earnings. Current liabilities, we have trade payable, we have current account to Palis.
Okay, thank you very much.
Welcome, sir.
Now, thank you very much. Let me now share my whiteboard. Now, question 15, page 35. The first thing is to draw up the structure, but before the structure, recall that we need to determine percentage holdings. We acquire 160 million shares, and I don't think we need to waste more time. If we check the question, we have share capital of 100 million naira at 50 kobo, which means if we convert it, that is 200 million shares, which approximates 80%. Okay, which means my group structure, I have Pali having stake in what? In Suzy, 80%. And I have my NCI, which is what? 20%. The acquisition took effect since incorporation of the company. And we will demonstrate whether we really understand what they mean by we acquire a company since incorporation. But we are reporting today, December 2015, at 4th December 2015. Now, let us try to separate the Suzy's reserve as at today. What is Suzy's reserve as at today, that 4th December 2015? Suzy's reserve is what? From our balance sheet is 60 million.
60
We
million.
need to split it into pre-acquisition and what? Post-acquisition. Now, what is our pre-acquisition reserve from this question? Who can tell me? And what is our post? Ifeanyi, you are raising up your hand.
Hello, sir.
Yes, okay, madam.
Pre-acquisition is 0 since they acquired the company since incorporation. That means there's no existence of there's no existence of Suzy right from time until they acquired it. So there's no pre-acquisition.
Thank you very much. That is I think this will be the first time in the last 5 years I've used this example that somebody will give me the answer exactly the way it is. It's 0. The word incorporation means a business is just being set up. Therefore, where do you expect a reserve or retained profit to come from? Where? And that is why I emphasize that some people will be looking for date. They didn't give us date. They didn't give us this. They didn't give us that. It's because the principle is not there. Since incorporation, whether they now give you that specific date is irrelevant. Incorporation means nothing has happened. That is the first, it's like that is when the company is given birth to. And nobody is giving birth to with money in bank account, with anything. Everybody came empty-handed. On that basis, I don't know who that person is. When we see next week, I'll give you a copy of my book as a consolation prize. Is that okay?
Yeah.
Okay, no problem.
Thank you, sir.
Okay, which that means that my post-acquisition is 60 million. That is that. Now let's move further. Let's quickly determine goodwill, if any. Cost of business combination. Pali's investment in Suzy is 100 million. NCI is measured at proportionate share, 20% of the net asset, which is unknown. Now let's determine the fair value of Suzy's net assets as at the date of acquisition. And that is made up of share capital. Share capital is 100.
100.
And pre-acquisition reserve here is 0. 100 plus 0 is 100. Therefore, 20% of the net asset, which is 100, is 20. When you sum it up, you have the full consideration as 120. Compared to the net asset, we have goodwill of 20. Now, what next do we need to do is we need to determine our consolidated reserves and NCI as at the reporting date. CR is consolidated reserve, NCI is non-controlling interest. What is Pali's reserve as at today? I think 140 has nothing to do with NCI. What is the value of NCI as at acquisition date? NCI as at acquisition date is 20. Can you remember?
20, yes.
Okay. 20. Now, what is common to both is share of post-acquisition profits. And they have to share it ratio what? 80-20. What are they sharing? They are sharing this 60, which is the return. Is that not? Okay.
Yes, sir.
80% of 60 is 48, and 20% is 12. Okay. No other adjustment. We have 188 and we have 32. Now, What is unique there is that when we go back to the question, who can tell me what is unique in this question, as simple as it is?
Current account.
Okay.
Okay, I want to share the screen now. What is unique in the question?
Current account
The
of
current
Suzy and
account
current
have the
account
same
of
balance.
Yes, you find that salient here, we have current accounts receivable from Suzy. How much? 10 in the books of
10.
Pali. Also,
And
current
payable.
account payable to Pali in the books of
Pali,
Suzy.
yeah.
How much? 10.
10.
They don't need to tell you. There are 3 ways in which they can tell you this information. One is this way, that they separate the current account from other receivable and payable. And they are just silent the way they are silent like this. Nobody will tell you anything. But you that you have financial statement have to review the financial statement to have better understanding of what is going on. Second way they can give to you is that as an additional information, they will tell you specifically that there is balances between these 2 parties of so much. The third way they can do it is that they will include it in trade receivable. You can see this trade receivable. Instead of writing 15, they will write 25. And they will just put it in bracket, included 10. And in this trade payable, instead of writing 14 here, they'll put 24. And they'll just be, you know, you need to look for, see, as a professional, you must have a query mind so that you are always intuitive in your reasoning, in looking at things. You don't look at things the way ordinary person would look at it. When you go to the hospital and you have ailment or you are sick, doctor will open your eyes, open your mouth, do all sorts of things. If myself open your eyes and I can't see anything because I'm not trained to even picture anything out of it. The same way, if I pick account of a company, I can tell you little thing about that company that will always be right. It's because I have that understanding. The same way you guys have to develop yourself, not that you must be an accountant that they must tell you what is going wrong or what is going right for you to know. No, you should be able to independently assess and tell them the larger part of what is going on, whether right or wrong. And that is the emphasis that we are making in this case. Are you getting it now? Okay.
Yes.
Now, let's move on. Now, which means there is an intercompany balance of 10 million, which is in agreement that we need to eliminate. Therefore, I'll come here and say elimination of intercompany balance. Now, if you want to eliminate, the simple meaning is that we are canceling out a balance. Now, if you want to eliminate, let me go back to the slide, to that question. If I want to eliminate this 10, remember, this is a current asset. This is a debit balance. If I have to eliminate it, I have to credit it. Is that correct?
Correct. That's correct.
If you want to eliminate a debit balance, you credit it. If you want to eliminate a credit balance, you debit it, which then means that I can come back to say my current account payable to Pali will have to be debited, and current account receivable from Suzy will have to be credited. That is the methodology for cancellation. With how much? With the Common factor, 10 million. Now we are going to see how this is reflected in our balance sheet. Pali Group. Okay, PPE. What do we have? 110 and 120. That is 230. Our goodwill was 20.
20.
I'll call this 250. My current assets. I have inventories.
30 plus 45.
30 plus 45, that's 75. I have receivables. That is 15.
15
plus 12, that's 27. I have my current accounts. I have 10 and 0, Abby, but I have 10 and 0. Now, but remember, we said we should credit this current account by 10. Doing that means if you credit a debit account or an asset account, you are removing from it. Let me change the color.
Hello, sir. Can you repeat what you just said? If you credit a what?
If you credit a debit account, what are you doing? Are you adding to it or removing from it? You are removing from it. That's what I said. Therefore, there's also an item that is less, which is bank. What is our bank account?
5 plus 7.
5 plus 7. That is 12. When you add it together, what do you have? $75 plus 27 plus 12.
114.
114. 114 plus 250. That's 364. Okay. Equity and liability. Share capital
8 million.
and reserves. What's our share capital? It's Pali only. How much? 80.
8 million.
What is our retained earnings as consolidated? Go back up. That's 188. That's 268. This is equity attributable to Pali. NCI is 32, if I'm not mistaken, 32. That should give me 300. That's my total equity. Now, next is my current liabilities. I have payables. What's my payable? 50 and 14. That is 64. And I have the current account, which is 0 and 10. Abby? But if you go back here, we said we should debit a liability account, which means deduct from a liability account how much? 10 million.
10 million.
I come here, I deduct that 10 million. What do I have? Is 0.
0.
64. In baby, I have 364. Now, what you find out here is that eventually we have knocked out the asset against the liability. Let me try and reduce it so that you can see it at a glance. Don't mind the size, just for you to see it at a glance. I've knocked out this side against this side. Now, what you need to know is that if it is not separated like this, if it's included in receivable, it will have been receivable. It will have been receivable, which is 25 plus 12 minus 10. Similarly, if it's included in payable, it will have been 50 plus 24 minus 10. You still get the same thing, which means intercompany balance elimination requires you to identify the common factor that is sitting as asset in one party's leg and sitting as liability in the other party's leg. And what do? You eliminate. Does that make sense?
Yes, sir.
Yes, sir. I have a question.
Any other question?
Just clarification, sir.
Yes, what's it?
So, sir, what happens if in the question, like the way we have the current account balance, which is 10, what happens if the figures are different, sir? How do we treat it, sir?
Yes, it's as if you know my mind. That is where we are going to. And I want you to read the question and we'll discuss it, and that's where we stop for the day. Okay? I want you to read question 16. Can you see question 16?
Ali PLC acquired
No, I want that guy to read it. I want that guy to read it.
Okay. Okay.
It's the one that asked that question. Yeah.
Pali PLC acquired 160 million of the shares of Suzy PLC. Since the incorporation of the company, the statement of financial position of the drawer companies as at 31st December 2015 were as follows. So we have the statement of financial position as at 31st December 2015. We have property and equipment. We have investment in Suzy, the current account inventory, account receivable, current account Suzy, we have 10. Bank, then we have total assets. We have equity and liabilities, ordinary share capital of 50 kobo per share. Then we have retained earnings, current liability, trade payables, current account, Pali, then total equity required. Prepare the consolidated statement of financial position as at 31st December 2015.
Does that question read your mind?
Yes, sir. We have current account balance here now, Pali, we have 8. Then for current account balance, Suzy, we have 10. So there's a difference of 2.
That means they are not in agreement. Hmm? You didn't
Yes,
answer.
they are not in agreement.
Yes, sir, they are not in agreement, actually.
What could have caused that, sir? You know, we discussed it as at the beginning of the class when I was introducing you to group transaction. But in order not to waste time now, okay, let me just take you back to it. We had discussion here. Okay, now, if the balances do not cancel out totally, what could have caused it is either of cash in transit or what?
Good in transit. Okay.
Or goods in transit.
Therefore, the examiner will now provide you information, whether directly or indirectly, to tell you what cost it, whether it is cash in transit or goods in transit. Now, if you go back to the question we solved, to this question you just read, it says, before the question, it says, we can equally explore situation where current account or parent and subsidiary do not agree, but attributed to cash in transit. Which means the difference between 10 and 8, what is the difference? 2, Abby?
2, yes.
Yeah. What is that? What is the cost of that difference?
Cash in transit. Goods in transit.
Goods, not goods. Now they've given us information that is cash in transit. I'm just trying to explain. Yes.
Yeah,
If you look at question 17, question 17 also is the same thing as that question 16. But it says that it is attributed to what?
Goods in transit.
Which means, first thing is for you to even be aware that there's a difference. And the difference can be whether goods in transit or cash in transit, or combination of goods in transit and cash in transit. Now let's solve question 16. Okay. Now, question 15 and 16 are the same thing. What I've done is to copy my same answer and see where the difference lie. I've copied it. I'll just clean it up. I'll just change it to question 15. Okay, let me go and get my eraser. Now I'm solving question 16. 16 is on page, it's still on page 35. Okay. All other information are the same. The only difference is that this is not 10 because it is in between 10 and 8. I don't know what it is. Therefore, what should I do? Should I say 10 plus 8 divided by 2, 9? That is not correct. Which means the first thing I have to do is to reconcile. Reconciliation of intercompany balance. Now I come back. In the books of Pali, what was it? In the book of Susie, what was it? In the books of Pali, I'll say as per books of account. This was 10, Abi. This was what? 8. Now, information reaching us says that there's a cash in what? Transit. And that cash in transit is the difference between 10 and what? 8, which is what? 2. Therefore, how do I account for it? Accounting what? Entry. If you have a cash that you have but has not been received, what do? You recognize it in your books. And to recognize cash in your books, do you debit cash account or credit cash account?
You debit.
You debit. You now debit group what? Cash and bank. And you credit the corresponding entry to either of the current accounts. Usually, you can pass it to the current account of Pali, which is the payable account. At the end of the day, what do you have? 2 million. What this simply means is that when you come here, you say less cash in what? In transit. When you remove it, because you are crediting an asset account, what you are doing is to reduce it. What is it? 8. 8. Therefore, this is now what we call the agreed intercompany balance. Which means what I will eliminate is not 10. What I'm eliminating after my reconciliation is what? 8 million. Somebody will say, why am I debiting, crediting Pali? What if I pass the adjustment against Susie? If you pass the adjustment against Susie, which means in Susie's book, let me just say, for example, I pass it against Susie, which is receivable, payable to Pali, which means in this case, I'm not going to less. I'm not going to deduct, or rather add. When I do that, what am I adding? I'm adding
the balance of the interest.
I'm adding to what? To this account, which shows 10, Abi? Which means I can now come back here and eliminate what? 10. Whether it is 8 you agreed to, or it is 10 you agreed to, the two amount will still be cancelled out. And that's why where you adjust it against, either in the books of Pali or Susie, does not matter because everything will still cancel out. Does that make sense, please?
Yes, sir.
Does that make sense?
Yes, sir.
Okay. Let me return back to what I did earlier. Okay. Now, we can now come to the balance sheet. And when you come to the balance sheet, all other information remains the same except for this. Let me try and clean this and make it neat.
Oh, Jesus Christ.
All of this will be affected. Let me come here too and make it neat. All of this will be what? Affected. Okay. I think this is also different. Now, let's go back to our balance sheet. You find out that our PPE is still 110, 120, goodwill 20, inventory 30, 45, receivable 15, 12. Now we have current account balance. Which is 10 plus 0, Abi?
Yeah.
But there's a first adjustment that says we should reduce this 10 by 2, which is the reason why we have 10 minus 2, which means credit that account. When you credit an asset account, what are you doing? You are reducing it. Let me use red. And later on, after doing that, we're now told that we should go further to eliminate the balance, which is the 8. Remember, once you have removed 2 from 10, it remains 8. We are now saying that we should cancel out the what? 8. And that's how it comes to 0. At the end of the day, we still have what do we have here? We have, and don't forget, what do we say about our bank balance? What will happen to your bank balance? It will increase by what? By 2. Because that cash before was hanging in the bank, like I explained in the case of GTB and Zenith. Okay, what then do you do is for you to add that amount to your bank balance. Plus 2. Because when you debit an asset, you are increasing that what? Asset. That is 14. 14 plus this is 116. What do we have? 356. Now our payable. We are told our payable is
366, sir.
50 and 16. 50 and 16. That is 66. Abi? And we have current accounts. Our current account is 0 plus 8, Abi?
Yes.
And remember, we have an adjustment here that says we should cancel out this by 8, which means when I come down, I remove the 8 to give me 0. That gives me 66. Everything give me what? 366. You said this is what? 366, have you?
Yes, sir.
Okay. That is that. Which means whenever the intercompany balance is not in agreement, the first thing that you need to do is this bank reconciliation. Which means what you need to do is to reconcile this position. And when you reconcile, you pass the relevant accounting what? Entry. And that will force you to what? To agree. Now, if you now look at question, the one we just finished is question 16, Abi. If you now look at question 17, let me just copy it. Question 17 is the same answer with question 16. The only difference is that instead of you adjusting for cash, what you're adjusting for is inventory. God bless you. It's inventory. Let me just copy and paste. Instead of you adjusting, this question, page 36, question 17, page 36. Now, the only difference is here. Here, instead of you making an adjustment, and you call it cash in transit, what I'll call it is what? Goods in what? Transit. Instead of me to call it cash in transit, I'll call it what?
Oh, cash.
In what? In transit. Now, instead of me to adjust it against cash, I'll adjust it against group what? Inventory. Are you seeing what I'm doing?
Yes,
Inventory.
sir.
Yes, sir.
Now, instead of me now to adjust against bank, since it's not bank that is affected, but my goods that is affected, I'm going to erase it from here, and I'm going to adjust it here, which means
Inventory.
bank is 12. There's no adjustment. Inventory that was 3045, there will be an adjustment of 2 to it. Instead of being 75, it will be what? 70. Is it 77?
47.
Yeah, 77 plus 27 plus 12 will still give me 116. And that's just the answer. Which means instead of adjusting bank, I'm just adjusting inventory because goods affect inventory, cash affect bank balance. Does that make sense?
Yes, sir.
Any question? Let me quickly save this. This overrides everything we've done so that you use it to replace everything you have downloaded. Any other question, please?
I have a question.
What's your question?
Okay. In the last example that it affected the inventory.
What did you say?
The last illustration that you gave that it affected the
Yes.
inventory. I see.
It's breaking. I can't hear you. Can you send a chat?
Hello? Okay,
Yeah,
I'll
wait.
send a chat. Huh?
Because it's breaking.
Okay, I'll send a chat.
Any other question? In 1 minute time, it will drop. You can, in 1 minute time, it will drop. You can download it.
Okay.
And on that basis, I'm sending you this stuff. You should solve this icon question for last diet.
Okay.
No, not for last diet, for the diet before the Corona diet. You know, Corona has scattered everything. I don't even know which diet it is. But this one is for November 2019, question 3. I'm going to add it to what I'm sending you guys now.
All right.
Please solve it before the next class. If you don't solve it, I might penalize you guys. I've sent it. Please ensure you guys download everything. Yes, Ekemezi said, regarding illustration 17, based on goods in transit, is it just the inventory it will affect in the balance sheet? Yes, it is inventory. It will affect in the balance sheet the same way it affected cash. But again, remember that there's an adjustment that affects the intercompany balance as corresponding entry, whether it affects it from the angle of the parent, which is receivable, or from the angle of the subsidiary, which is payable. You still arrive at the same position, or because you are still going to eliminate those intercompany balance. Does that answer your question now, Ekezeme?
Yes, sir.
Okay, thank you. Ifeanyi, you are raising up your hand. What's the question? Please ensure you guys download the final solutions to what we have discussed, which is our working materials, and also ensure you download the Pathfinder for you to solve. If you like, go and be checking the answer.
Yeah,
Remember, the answer provided by ICANN is just a marking guide. It's not an answer that explains or necessarily give you that explanation. It's for you to be able to present that explanation for me. Okay, yes.
Yeah.
Fine.
Also, I'm sorry. For the unrealized profit, is it like we did always state the percentage that was like sold or not realized, something like that? Would they state it in the question or like?
No, I think I've explained it. They will give you information whether by percentage, by absolute amount, or I gave you 3 illustrations. I told you one will tell you percentage included, percentage not included. Some will give you value. Out of 10,000 units purchased, 6,000 was sold. Which means anyhow they give to you, you must be able to figure it out. What proportion of what you bought was sold? That's just a simple question.
Okay, thank you.
Any other question? Now, can somebody quickly read this additional information? Okay, I think it's time. Okay, just go and do that. Okay, and also, I'm unable to lay my hand on the immediate last question, past question. Also, go to the last past question. That is the one.
I have the last question. I can send it to you.
Okay, yes, share it in the WhatsApp group. Send it in the WhatsApp group. Solve the group question there, okay, balance sheet, and solve this also. Is that okay?
Okay.
Have you all downloaded before I shut down the class? No. Thank you very much, and God bless you for your contribution.
No.
The download is not complete though.
Okay. Oh yeah, I'll leave it for next 2 minutes for you guys to look at. Thank you very much, and God bless you.
God bless you, sir.
Thank you, sir. The download is not coming in.